Hello, I am Mickey Granot, and I'm welcoming you to another session of Next Era Academy about theory of constraints. This time, we are going to do a brief introduction into throughput accounting, understanding how cost accounting practice is not delivering the results expected, even worse than that, and what can be a sane alternative to that. Little bit background about the importance of measurements as a whole. We are, as managers in companies, making decisions. And to make the decisions, mostly we use some form of data that is required to make the best choice. The data comes in few forms. One of them is measures that we are using, and financial measures are one of the key measurements used to decisions that are financially important. In a common way, we get those financial measurements from the financial system of the company, which is based on cost accounting. So all the measures, or most of the measures, will come from some form of a cost accounting background. Measurements are not only supporting decisions, are not only showing us where we are versus where we are supposed to be, and how well we are progressing towards our objectives, but they also create some other important effect on our lives. They impact the way we behave. Through that, as managers who are setting measurements in a company, we do expect that people will behave in a way that will improve the measures. In a sense, the reality of human beings is that we behave according to our measures, or another way, we can use this quote, "Tell me how you measure me, and I will tell you how I will behave." This is a tremendously important element of measurements. Not always you remember that this is the case. So, what measurements we get from the financial system of a company? We get measurements of the performance of the company as a whole through the financial statement of the company. We get measurements that help us in the decisions of investments through calculating return on investment that compares the cost of buying an equipment with the expected savings. We get measurements of that support us in the decision whether we should produce or subcontract things by calculating the cost of producing or supplying a service. We measure our subsystems by assigning to them individual profit and loss statements, and we also use the financial systems to validate whether or not a product or a service are viable. Do we really make money out of producing and selling those products or services? However, the cost accounting that is providing this can be actually defined as the biggest enemy to making good decisions. Not only it leads us astray, it does so randomly. So in a sense, when we make decisions based on cost accounting, sometimes it might work, other times it may not, and we will only know in retrospect. One of the reasons, or the logic behind it, is that cost accounting was never developed to support decision making. It was developed to enable external entities, i.e. the government, to evaluate the performance of a company in the past so that the government can define how much taxes this company needs to pay. And as it was doing that, it will also enable other entities that might want to invest in a company or provide credit to evaluate the performance of the company in the past. Looking at the company in the past allows to manipulate numbers in a way that does not exist in reality, in a fictional way. And converting these fictional measures that are done only because we have looked at the system in the past, well, if we use them to make decisions, we might get the hint of what we might expect of that. Just a few of those fictions are, for example, adding value to inventory. Uh, this is something we can do in retrospect because we know what was the cost in the past, what were the sales in the past, and how much inventory we had in the past. So we can assign financial value to inventory, which is over and above its direct cost. We use the difference between open inventory and closing inventory as parts of cost of goods sold, impacting our profitability through that. We can allocate cost, fixed cost, as if they are variable to any variable we want. So in the past, we can say the cost, let's divide it by the number of customers, by the number of units, by the number of people, by the square meters of the space we have, by any other thing you want to divide it to, but you only can do it because you look at the past. We also assign cost to artificial entities that do not exist, like cost of servicing a customer. The basic rule that is underlying everything in cost accounting is the assumption that the cost adheres to the additive rule, that the cost of one part of the system plus the cost of another part of the system plus the cost of another part of the system eventually adds up to the cost of the system as a whole. And again, this is only possible because we look in the past. In real systems, entities are interconnected. Cost generated in one entity has effect on cost generated on other entities. Therefore, they cannot be mathematically added. Only in the past they can. Let's look at an example. According to cost accounting, every product or service is either profitable or not. By this logic, systems should strive to sell their products or services profitably. And, well, mostly companies do so, right? No one is selling by choice most of their products or services in a loss-making fee or price. Again, it may happen, but not as a conscious decision consistently for everything or most of the things. So by design, we do that. So if we assume that selling profitable product or services adds up to a profitable system, and most of us are doing all the efforts to make sure that we are selling profitably, then it is practically impossible for systems to lose money. Have you ever heard about a company losing money? Something is wrong in this logic. Another example. Everyone today is aware to the fact that inventory is a liability. It became very understandable today. Cost accounting, on the other hand, thinks that inventory is an asset. When closing inventory is greater than opening inventory, we create in our P&L profit. So what do you see as behavior in many, many companies towards the end of the quarter, the end of the year? What companies are doing, they are inflating inventories towards the end of the measurement period. By that, they are creating inventory profit, but do they really make more money? Actually, the P&L shows profit, but practically costs have unnecessarily increased, investment has unnecessarily increased, and cash flow unnecessarily decreased. Yet, our profit and loss is showing profit. How does it look in real life? What is the alternative? How do we understand system in real life? Let's make it very simple. A system is a box. And in this box, we are placing investment. Investment is space, investment is equipment, investment is work in process, investment is the knowledge we invest in our employees. All of this is being placed inside that box. Raw materials, finished good, not sold. All of those are investment which are staying in the box. Now, this investment by itself can't do anything. We must convert this investment to throughput, to goal units of the system. And the only way we can do it is we put more money into it, which is our operational expenses. So basically, operational expenses are turning the investment, and through turning the investment, we can generate throughput, and through generation of throughput, we can advance towards our goal. So the throughput is defined as the rate in which the organization creates goal units. Operating expenses is all the money we spend in order to create these goal units, which are salaries, electricity, water, utilities, any other thing. And investment is all the money which is captured inside our box in order to convert it into throughput. Once we understand these two simple measures, we can define a few financial measures. Throughput is measured as sales minus truly variable cost. Truly variable cost is the cost that actually changes by the unit sold. All costs are variable, yet truly variable cost changes by the unit. For example, raw material. We sell another unit, we will consume another unit of raw material. We will not consume it. Once we define throughput and we know what operational expenses are, the net profit will be the difference between throughput and operational expenses, and return on investment will be net profit divided by investment. We can also measure productivity in a financial way, not in the artificial efficiency way production companies normally do, which will mean throughput, how much money we really make, divided by the operational expenses, how much money we are using to make that money. This will give us the productivity of the system as a whole, and we can measure investment return. So TINOE, throughput, investment, operational expenses, are the operational financial measures that enable us to calculate all the other measures. Now when we understand these three key measures, we can understand a new way of making decisions. We can make decisions by evaluating the change in each one of these core measures, the change in throughput, the change in operational expenses, and the change in investment. We don't need to even have the actual real numbers to start with. We can evaluate each decision by estimating the effect it will have on each one of these three measures. And by knowing the effect on throughput and OE, we can calculate the effect on net profit. Knowing the effect on I, on the investment, and net profit, we can calculate the effect on return on investment. Financially, any system needs to thrive to increase throughput faster than increasing operational expenses. This is what they need to do. This is what should be the financial target, because if throughput grows faster than OE, then profits and profitability will grow as well. So let's take an example and see through an example, how would you make a decision using cost accounting, and what would be the real effect of the decision, and how would you make it in throughput accounting, and what would be the effect of that decision. Simple example, a company with a sales of 100 million euros and currently making a loss of 2. The company has excess capacity to increase sales volume by 20%. The company can sell this additional volume in a segmented market for a price which is 30% lower than the current prices. So this company right now is presented with an opportunity. Sell the excess capacity you have, however, you must do it on a much lower price. Raw material, subcontracting, and shipping, truly variable costs, are in total 40% of the current selling price. Direct labor is 60% of total operational cost. What should the company do? Let's take a look at it from the cost accounting profit and loss. Sales are $100 million. Cost of goods sold, we will not consider inventory here. Material is 40%, therefore 40 million. Direct labor, 37 million. Therefore, total cost of goods sold is 77 million euros. Gross profit, 23 million. Operational expenses, 25. And the company is losing 2 million euros. This is the P&L before the decision that is on the table. Now let's evaluate it. The first thing people will say, even with the existing prices, we already are losing money, so 30% lower prices, it is insane. 20% of the capacity in terms of potential additional revenues in regular prices, not discounted prices, is 25 million euros in sale. As cost of goods sold is 77% of sales, it will be 19.25 million euros. If we sell 25 million euros with 30% discount, it means we are selling it for 17.5. 17.5 minus 19.25 will bring a loss of 1.75 million euros. Therefore, with all due respect, this new additional opportunity is not a very good one. You might feel that this is extreme and that you intuitively would make a different decision, and you might be right, but life is not full with such clear cases in front of us. Oftentimes the cases are much less clear, and we will use the financial system to make this evaluation. Let's look at it from a throughput accounting. Sales are 100 million. Truly variable cost is 40%, is 40. Leaves us with a throughput of 60 million euros. Operating expenses of 62 million euros. Net profit, 2 million euros loss. This is before the decision. What is the decision putting us on? Sales of 17.5 million, which is 25 million with 30% discount. The TVC is 40% of 25 million, 10 million euros. The delta throughput is 7.5 million. There is no additional operational expenses because we have excess capacity. Therefore, the delta net profit is 7.5 million euros. So based on throughput accounting, not only this sale is a good sale, it will swing the company from making a loss of 2.5 million euros to make, of 2 million euros to make a profit of 7.5. Summary. Throughput accounting provides a consistent decision support financial calculations that always guide the right decisions. The key considerations are the change in throughput, the change in operational expenses, the change in investment. Keeping in mind we need to make decisions that deliver a faster rate of growth of throughput in comparison to the rate of growth of operational expenses. In brackets, we do not mind growing OE. Cost can go up as long as the throughput goes faster than that. So there is no real objective of cutting cost. There is an objective of growing net profit. Net profit goes from the combination of throughput growing faster than OE. As a result, decisions at all areas of the systems are aligned with the overall objective of the system as a whole. That's a brief introduction to throughput accounting. More details in one of the future sessions. Thank you for being with us.